Without further ado, welcome to the channel. In this video, we'll be taking a look at online trading. We'll be focusing on the biggest financial market in the world, where about $6 trillion is exchanged daily between participants worldwide. Our aim here at Money Never Sleeps Africa is to try and explain the topics that most people find difficult to understand in a much simpler manner. We try to keep it short and simple. The biggest financial market in the world by far is the Forex market. Forex or FX refers to foreign exchange in which the different foreign currencies of many countries around the world are traded. The Forex market is basically an electronic network of participants like governments, banks and other big institutions, and even some individual retail traders who generally trade and exchange currencies through Forex brokers. But for you to fully understand this, we need to break it down further. We first need to agree on two things. Agree that a market is a platform where people exchange goods and services or money, right? And that trading is a process of exchanging goods and services from one person to another person for other goods and services or money, right? So we can basically agree that the Forex market is a platform we are given to engage in exchanging one currency for another. We simply buy or sell currencies when the value fluctuates in hopes of making a profit from these differences in the exchange rates, and all of this happens online. This is basically what Forex trading is. You're simply exchanging one currency for another currency in hopes of making a profit. Here's a more practical example of this. Imagine you're traveling from South Africa to the United States and you have 20,000 Rand with you, and upon reaching the border of the USA, you have to exchange your currency from South African Rands to US dollars. And if the exchange rate at that time is 13 Rand for $1, meaning that for each $1 you're going to get 13 Rand, then your 20,000 Rand will be worth about $1,538, right? Then upon returning to South Africa, it happens that you didn't spend the $1,538 you had, and now you have to exchange it back to South African Rands when you reach the South African borders. But now you find that the exchange rate has also changed too, and is now 15 Rand for $1, meaning that for each $1 you're going to get 15 Rand. Such changes in exchange rates might happen because of fundamental reasons. For example, a sudden change in the country's president, inflation rates, or even geopolitical reasons like war. Now that you're on your way back from your trip, the exchange rate has changed too, and is now 15 Rand for $1. So the 20,000 you had at the beginning of your trip is now 23,077 Rand, meaning that the $1,538 will be multiplied by the 15 Rand exchange rate. This means that there's an increase in dollar strength against the Rand. You would have made a profit of about 3,077 Rand just from your trip, because the dollar increased in value or the South African Rand decreased in value while you are on your trip. This is how money is made when trading Forex. Now I know that for some people this might seem a bit confusing, but you'll realize that it's easier once you start doing it practically with a practice account. You don't necessarily have to travel physically for you to make such profits from fluctuations in the exchange rates. Remember, we have our Forex market platform to facilitate this whole process. This is what we do when trading Forex on our trading platforms. We're simply buying and selling currencies and nothing else. It is also important to know when you're trading Forex, you can't just buy or sell with one currency. For example, you can't just buy the United States dollar by itself. You have to trade it with another currency like the South African Rand. This is what we call a currency pair. A currency pair is simply the value of one currency quoted against the value of the other currency. The first currency in the currencies pair is what we call the base currency. Then the second currency is what we call the code currency. The code currency is basically how much the base currency is worth when measured against the code currency. If you take a look at this USD chart, you'll see that on this day, $1 was worth about 15 Rand and 30 cents. And if you wish to buy this USD currency pair, what this means is that you are buying the United States dollar and at the same time selling the South African Rand. You would buy the pair if you believe that the base currency will gain value against the code currency, meaning that the dollar gains strength and the Rand will weaken. Or you'd sell the pair if you believe that the base currency will lose value against the code currency, meaning that the dollar loses strength and the Rand will gain strength. There are certain currency pairs that you should focus on when you're a beginner. These are called the major pairs, simply because they are the most traded and the most chances of profiting from trading these pairs. These are the pairs that are safe enough for you to trade as a beginner, but that does not mean you should trade them more. It's also an advantage to be aware of the 4 major Forex market sessions, because you'll have to trade during certain periods of times according to which market is open and the volatility of that market. You get your Asian session, your Australian session, the London session, and also the New York session, and all of these sessions open and close at different times. Now that you're familiar with the basics, we can talk about the 3 ways in which you can approach and analyze the financial markets in order for you to make good trading decisions. The more popular preferred type of analysis by retail traders is what we call technical analysis. Technical analysis in Forex is when a Forex trader examines the previous price movements on the charts. You'll be looking at the historical price movements on the charts to determine the current trading conditions and potential future price movements. The main objective of technical analysis is to be able to profit from trading by observing the market patterns, statistics, and to know when to enter and exit the market. This type of analysis also limits emotions that influence trading decisions. Another way in which you can analyze the market is by using fundamental analysis. These are economic indicators and principles that are important in the country's economy. They form the foundation for which decisions are made in Forex and other markets. Fundamental analysis involves looking at the economic news and factors that affect the valuation of a country's currency. The thought behind fundamental analysis for Forex is that if a country's current or future economic picture is strong, then its currency should strengthen and vice versa. The healthier a country's economy is, the more business and investors from other countries will want to invest in that country. This results in a bigger demand for that country's currency. Then the third way in which you can analyze the market is by using sentimental analysis. This shows you investors' sentiment and how they feel towards the market and whether they are buying or selling. The main idea is that the majority of traders are emotional and tend to overreact at the beginning of the trading day because of overnight news and economic data. So understanding how and where investors are moving their money is going to give you a trading edge over the majority of traders who don't know this. If the general mood or sentiment of investors towards the currency pair is positive, then the pair will likely move up and vice versa. But before we dive into opening trades, it's also crucial for you to understand what pips are. Maybe you've heard many traders saying they're catching pips, right? Pips are the smallest increment or change in the price of a currency pair. When the price of the currency pair begins to fluctuate, the slight increment or decrease in the price is measured in pips. Now with all this information, you might be wondering how you place your first trade. Let's talk about this and the process that's involved in placing a trade. After you've done your analysis, whether it's technical, fundamental or sentimental, or a combination of the three, and you've now spotted an opportunity to make money in the market, opening an order just requires a click of a button. You've got two options. It's either you're going to buy or sell. Remember we mentioned earlier that when you sell, you're expecting the price to fall in order to make the price to rise in order for you to make money. Now after you've placed the trade will continue running, and if it's in profit, then you will continue making profit until you decide to close your position. You also need to set two exit points, a take profit point and a stop loss point. An open trade will only be closed if it hits your take profit or your stop loss. Your trade can also be closed manually, or if the trade goes against you and you don't have your stop loss in place, then your account balance will be reduced to 0. Your TP or take profit is a point in price you set where the trade closes automatically if you are in profit, and the opposite is true for your SL or stop loss. Your stop loss is a point in price you set where your trade closes automatically if the trade goes against you or is in a loss and hits that predetermined price. Now that you have an understanding of what the Forex market is about, this is what you're going to need to start trading. Firstly, you must have a device that you're going to use to trade. This is where you can access your trading platform and account, so you're going to need a laptop, PC or smartphone. You also need a good internet connection. Your device must be able to connect to the internet because when you trade online. The process of exchanging currency has to happen over a trading server. Next, you're going to need a trading platform. To trade, there must be an application that has all the necessary equipment to communicate with the rest of the market and your account. I recommend use a trading platform called MetaTrader. Then you need to open a trading account. This is where your transactions take place. This is similar to a bank account. If you don't trade the money, then the money will remain the same. You'll then have two options. It's either you're going to open a live account or a demo account. A live trading account is simply an account that is funded with real money from your pocket. But if you're a complete beginner, I'd recommend that you open a demo account first. A demo account or practice account is a trading account that uses virtual or practice money. Many people say that trading Forex is dangerous and risky. I say investing in anything without the proper knowledge is the real risk. So hit the like and subscribe button so that we can continue uploading videos that might be helpful to you. Danko.